The JEPI ETF has been a favorite of dividend investors for several years now, and this is because of the consistent monthly dividend, which some investors rely on to help cover bills, or of course use the income to reinvest to purchase more shares of whatever. But when it comes to JEPI, there are some aspects that investors should fully understand, and maybe even be a little bit concerned about. In this video, we are going to dig deep into the JEPI ETF and go over some of the main concerns that some investors might be missing. Now we are going to go over all of this and more in today's video. Right after you, please drop a like on it and subscribe for more content like this in the future. So the JP Morgan Equity Premium Income ETF, known as ticker symbol JEPI, has made quite a recovery over the last year. Currently up year to date around 1.4%, but actually up substantially in ETF price, considering back in March JEPI was trading around $52 per share. Now looking a little bit deeper into this ETF, the current 52-week range is $49.92 as of the low and $57.89 as of the high. Now before we go into some of my major concerns, let's head over to the JP Morgan website and learn a little bit more about this ETF. So here in the JP Morgan website, it says seeking consistent premium income with lower volatility. The JP Morgan Equity Premium Income ETF seeks to deliver monthly distributable income and equity market exposure with less volatility. It also says that the portfolio managers with over 60 years of combined experience investing in equities and equity derivatives. Now the portfolio, defensive equity portfolio, employs a time-tested bottom-up fundamental research process with stock selection based on a proprietary risk-adjusted stock rankings, and also discipline option overlay. Implements written out of the money S&P 500 index call options to generate distributable monthly income. So simply put, JEPI buys into a basket of stocks and then sells a cover call option over the stocks, generating significant premium and dividends, of course, which allow JEPI shareholders to earn that nice juicy dividend every single month. So you might be saying, well, as of so far, JEPI seems actually pretty decent, and I would have to agree with you. I actually hold quite a bit of JEPI in my portfolio, but to get into one of the first reasons on why it might not be a good idea to buy into this ETF is going to be the overall ETF share price performance over the last few years. You see, if we compare JEPI's price performance next to the QQQ and the S&P 500, you can see that JEPI has clearly underperformed the Qs and the SPY by quite a bit over the last 1 year time frame. But it's not just the 1 year time frame either, which is concerning. Even over the last 3 years, JEPI has returned 7.78% as far as ETF price, where the Qs have returned 42.4% and where SPY has returned 40.53%. But wait, I know what you might be saying, well, that doesn't include dividends, which is a very good point. And with dividends over multiple different time frames, JEPI's returns have actually not been quite as bad. Year to date with dividends included, JEPI's returned 6.03%, where the Qs have returned 41.19% and S&P has returned 18.3%. Now again, this is with dividends included. On the 1 year time frame, JEPI's at 10% return. Qs are at 28, SPY is at 17. On the 3 year time frame though, it's actually much more even. Where JEPI with dividends included has returned around 42%, Qs 45, and SPY 47. So to be fair, with dividends included, investors would have received pretty much around the same returns over the last 3 years, whether they bought into JEPI, the Qs, or the SPY, which I will admit does give a pretty good argument for JEPI. But on multiple other time frames, even with dividends included, the total return performance for JEPI is somewhat worrisome. The next thing that's sort of worrisome when it comes to JEPI, and what I want newer investors especially to look out for, is the fact that JEPI's dividend has been decreasing significantly. Now because JEPI's strategy is to buy a basket of stocks, sell cover calls on the basket of stocks, and then basically wait and see what the market's going to do within that time frame, JEPI's distribution, the dividend paid on a monthly basis, is definitely going to depend heavily on how the rest of the market is trading. You see, if there's more volatility, less volatility, if the covered call is in the money, out of the money, the distribution amount is going to be different moving forward. And as you can see over the past 3 or so years now, the distribution amount is definitely anything but consistent. There's been months where JEPI pays 54 cents, and then the next month after, 26 cents per share. And as of recently, the last, I want to say 4 or 5 months straight, the distribution of the dividend has been continuously moving down, which especially for more income-focused investors that are relying on this distribution, this dividend, to cover their bills, or really needing this money for something important, that's definitely something to be concerned about. Because after all, if you're buying into this ETF thinking that you're going to receive a 61-cent dividend, like this ETF definitely did pay back in October and November of last year, it's just not necessarily going to be the case. Because after all, as of the last few months, this ETF has distributed about half that. So moving forward, I'm not necessarily saying that JEPI is going to for sure return a lesser dividend than what we're already seeing, but it is something to be concerned about. And even speaking for myself, when I first started buying into some shares at JEPI, I didn't really do my own due diligence and really look closely to see how volatile the monthly distribution can really be. Now, the last thing to definitely be concerned about when it comes to investing into JEPI is to understand the holdings, the holding breakdown, and ask yourself if or if not this is the basket of holdings you want to be invested into long term. So JEPI's holding breakdowns are the following: technologies around 17%, industrial 13%, healthcare 13%, consumer defensive 13%, financials 12%, consumer cyclical 9%, utilities 5%, communication 5%, real estate 3%, basic material 3%, energy 2%, corporate 14%, and cash and equivalents around 1%. Now, the top 10 holdings for JEPI are very respectable companies. Things like Adobe, Amazon, Microsoft, MasterCard, Comcast, Visa, Accenture, Progressive, Pepsi, and Hershey. Now, the main concern that I particularly have as of right now with the basket of holdings that JEPI has is the fact that I personally would like to have a higher emphasis on technology and growth within the portfolio. See, if we look at an ETF like JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. Now, this is a very similar ETF, but the difference is that the holdings are broke down much differently. Technology is over 50% in the JEPQ ETF. And this is partially why the JEPQ ETF is up 18.91% since the beginning of this year, and that's just in ETF price. Now, even with that massive capital appreciation, JEPQ has still paid a massive dividend amount on a monthly basis, at least it has so far historically. So that brings me into the exact reason on why, as of the last year or so, I personally stopped purchasing shares at JEPI and have been going much more heavy into the JEPQ ETF. Because with the overall strategy of the JEPI ETF and the holdings, and of course the way the ETF price has been trading over the last year, I think there could definitely be an argument saying that JEPQ is going to outperform JEPI long term, especially during times in the stock market when the market's overall doing quite well. So there we have it. There's a quick overview on JEPI as of right now, and 3 reasons on why I think investors should be wary when investing into the fund. I want to hear from you guys down below when it comes to JEPI. Is this an ETF that you're holding on to long term as a more dividend focused, income focused investor? Or would you happen to agree with me and think there might be better options out there? If you enjoyed this video, make sure to please drop a like on the video and subscribe for more content like this in the future. Thanks as always for stopping by, guys, and I'll see you in the next one.